Now we will take a moment to introduce you to our speaker. Our speaker today is Dan Merritt. Dan is a senior manager on Raymond's Public Sector Assurance and Financial Reporting team. He is a member of several professional organizations, including the American Institute of Certified Public Accountants, the Michigan Association of Certified Public Accountants, the West Michigan chapter of the Association of Government Accountants, the Michigan Government Finance Officers Association, and the National Government Finance Officers Association. Dan is a CPA and a certified government financial manager with over 10 years of experience in the governmental arena as an auditor, consultant, and contracted finance director. Dan, you may begin the presentation.
Thanks very much, Ashley. That's a better introduction than I could have come up with myself. To all those of you who are existing Raymond clients and have been participating in these webinars for a number of years, welcome back. It's wonderful to have you. For those of you who are new, we're very excited to be sharing with you today the beginning of our annual webinar training series on topics that we think are important to local government. Today's presentation is going to be primarily about current and upcoming GAAP standards. When we get to the end, I'm going to talk about some of our future and upcoming training offerings. We don't always focus just on the accounting side. We do offer training on other topics as well. If you've been participating in training sessions that I've given either through this webinar series or through other professional associations, you're going to be cheering this morning because you'll notice that our session outline does not include GASB 87. I feel as though ever since we began doing more regular post-pandemic training sessions, we've talked extensively about GASB 87, the lease standard. So I'm sure everyone is very tired of listening to me talk about that particular topic. You'll also notice that we're going to spend a little bit of time reviewing and recapping GASB 94, as there might be a couple of organizations and institutions who are 12/31 year ends or 9/30 year ends who still have yet to complete their implementation of GASB 94. So we'll just give a very high level cursory review of that. After that, we'll deep dive into GASB 96. If you're a June 30th year end, hopefully you've now finished your implementation of GASB 96 and you've been around the block once already on this, and that's great. And our 12/31s are just getting into their full ramp up for implementation. Finally, we're going to talk about a couple of the upcoming standards that there are out there, GASB 100, 101, and 102. I'm going to guess that most of us are the most concerned in that list about GASB 101, the upcoming standard for compensated absences, but there are some important things to address in GASB 100 and 102 as well. So let's dive right in, thinking about GASB 94, which is the standard for public-private and public-public partnerships, as well as APA's availability payment arrangements. Now, GASB 94 is one of the sort of three long-term standards that the GASB put out around what do we think that are long-term arrangements that governments are entering into that involve right-to-use assets that really should go onto the balance sheet of organizations operating under GASB standards. GASB 94 is about public-public and public-private partnership arrangements. So an arrangement in which the government, who is usually referred to as the transferor, contracts with an operator to provide public services by conveying control of the right to use a non-financial asset. Usually those things are things like infrastructure or capital assets such as a parking garage or some other public use asset in an exchange or exchange-like transaction. So a long-term arrangement with an outside third-party vendor to operate a service, usually involving some type of underlying asset. Now, we use a lot of terms here. Transferor. Transferor under GASB 94 is always going to be a government. Kind of lines up with the lease standard language as being a lessor. Operator could be a government. Kind of lines up with the idea of being a lessee under GASB 87. But also the standard does note that, remember, we said it's public-private or public-public. So there's a possibility there are some circumstances in which the operator might also be a government. So you could have a long-term agreement to share right to use of some asset with another government. Potential for a PPP liability an intangible right to use asset, the underlying asset, like an existing asset that exists, and or maybe even a PPP receivable or a PPP deferred inflow. Again, remember, this is sort of mirroring our language from GASB 87 around lessor or lessee. And you notice if you were to really dive into the accounting for the arrangements that exist, you'd notice that a lot of the accounting is pretty similar, if not near identical, to what happens under GASB 87. I've looked at the financial statements for a couple of governments that have had to implement GASB 94, and the disclosures and the footnotes look very, very similar to what you have to do for GASB 87 as well. However, I have noticed that this is a much less common, at least in my client base and the organizations that I work with. This is a less common arrangement for local governments than it is for than GASB 87 or 96. And I think the primary reason for that is sort of twofold. One, most of the PPP arrangements that meet GASB 94 definition are PPP arrangements because they're service concession arrangements. You see it in front of us like sort of a little flow chart that exists right in the standard, talking about what might meet the definition of a PPP arrangement. Well, most of the things that I think we find are those that are already service concession arrangements under GASB 60. And most governments don't end up having arrangements that meet these qualifications, because one of the key pieces of the flowchart in GASB 60 around do you meet the definition of service concession arrangement is giving up control over what rates can be charged, i.e. the vendor gets to decide, or the third-party government gets to decide what those rates are. And I find that most local governments aren't willing to give up that control without significant compensation, and even then might not feel like it's an adequate service to their constituents to give up that control when they are the ones with the accountability. I have noticed that some higher education institutions have had contracts that meet this definition. The two most common areas tend to be parking and housing. And again, like if they're willing to give up that control over what rates are charged and give that third party the right to collect that revenue, they might end up having a service concession arrangement. Otherwise, it gets the definition gets much narrower and into much more narrow situations. Those that don't meet the service concession arrangement definition, you'd have to have an underlying PPP asset that wasn't the existing asset of the transferor, or an underlying PPP asset that was an existing asset of the transferor, but significant improvements were still required to be made by the operator in that arrangement to meet the definition under GASB 94. So if you take nothing else away from this brief discussion of GASB 94, what I take away from it is if you have something that you think meets the service concession arrangement definition, or you think might meet the narrow definition for a GASB 94 implementation that's not a service concession arrangement, talk to your auditors and start thinking about documenting that clearly and quickly, because you'll need to start thinking about if you meet one of the types under GASB 94. Now, these are GFOA definitions. These aren't necessarily straight GASB definitions, but the GASB gives us some general types, sort of branching off that decision tree into a type 1, type 2, or type 3, where you have an underlying PPP asset that is an existing asset with or without operator improvements. You have type 2, you have an underlying PPP asset that's a new asset acquired or constructed by the operator, and it's a service concession arrangement. Or you have a type 3, an underlying PPP asset is a new asset which is being acquired or constructed by the operator, and the PPP is not a service concession arrangement. The GFOA then gives us some basic ideas about if you fall into one of these type categories, that you might end up having a receivable for future PPP payments and a deferred inflow of resources, or you might have an addition to capital assets and a deferred inflow of resources. Basically, the GASB wants you to make sure that if you've got this public-public or public-private partnership arrangement, that it's going to end up on your balance sheet either to recognize the fact that someone is providing you future resources or that they're providing you a future capital asset. Again, you have a type 3 that could end up being a receivable and for both the payments, the asset, and the deferred inflow of resources onto your balance sheet. Should just briefly mention, again, I just want to reinforce here the idea that the measurement for a GASB 94 arrangement is very, very similar to the measurement for GASB 87 or GASB 96 arrangement, all the way down to thinking about how the term works, thinking about periods that are reasonably certain based on the relevant factors that the operator might exercise that option, thinking about situations in which the transferor might exercise an option or will not exercise that option. These are all situations in which they're sort of one-sided terminations. They're situations in which either the operator or the transferor can exercise this option one side only, not situations in which they both could cancel the agreement at any time. Finally, brief description, because it's in the name of the standard, I don't want to go without mentioning this. Availability payment arrangements are basically situations in which you have an odd contract to construct an asset or finance a purchase of an asset that might not be couched as a finance purchase, but if you really read down to the underlying, what is this thing, like we'll provide you certain payments over time, really it ends up being a finance purchase of that asset by the government. And the GASB says, well, we want you to treat that thing like it is that thing, even if we don't specifically call it that in the contract. So that's GASB 94. Let's talk about some of the meat and potatoes here. The subscription-based information technology agreement standard. Now, again, if you're a June 30th year end, you've already been through implementation one time around on this. But if you're 12/31, you're probably finishing up your implementation process and getting ready to be audited. So I think this brings us to polling question number 1. How much preparation have you done for implementation of GASB 96? Either A, we're already implemented, we're pretty prepared, we're somewhat prepared, we're just starting, or you're just hearing me talk about it for the first time. Perfect. Hopefully everyone got a chance to answer that polling question. So what are we going to talk about? Well, you're going to notice that this standard is going to be very similar to what you heard me talk about last year with GASB 87. We're going to talk about what is a SPITA, what is the subscription term, how do we measure the asset and liability that we might be required to put onto our balance sheet, what does the accounting treatment look like, and your financial statement disclosures, what might those look like? And then I'm going to spend some time talking about some practical considerations and maybe some lessons learned from our time auditing and working with local governments and other organizations in implementing this standard over the last 6 to 9 months. So what is a SPITA? Well, a SPITA is a contract that conveys control of the right to use another party's information technology software, alone or in combination with tangible capital assets, as specified in the contract for a period of time in exchange or exchange-like transaction. What does that mean? That means that you have an agreement with a third-party software vendor for some type of subscription software, and usually that means you have a login to use that system, and it's over a period of time, usually greater than 1 year. We'll talk a little bit more about the greater than 1 year portion when we talk about the subscription term here, but we're looking for a long-term contracts where we have the right to use someone else's subscription software, and thinking about how do we end up putting that onto our balance sheet in a manner very similar to capitalizing an asset as if you sort of like financed it with a long-term liability. To have a SPITA, you also have to have control of the right to use that software. And that's defined by the GASB as the right to obtain the present service capacity and the right to determine the nature and manner of use of the underlying asset. I haven't seen a lot of situations for GASB 96 where I think that the government does not receive the right to use the present service capacity and to determine the nature and manner of use of the underlying asset. Maybe there are some situations in which you might get read-only access to a database, and you might argue that you don't have really the control over the nature and manner of use. So when you get to those specific technical situations, it's a good idea to talk to your auditor. But I think that that's probably less common with SPITAs than it was with leases, where you had some odd situations where you might only get to use it for certain time frames, or you might have shared use of the space, something like that. There are specific things that the GASB excluded from GASB 96. First, they said anything that you've already accounted for a lease under GASB 87, you don't need to worry about for GASB 96. If it met that lease definition, we're good. You don't need to think, is this also a SPITA? Though you might have contracts where there are both physical assets being provided and subscription assets. The GASB calls that a multiple component contract, and we'll talk about that in a moment. Second, it excludes contracts that are solely to provide support services, i.e. that wouldn't really meet the definition of having a right to use asset, right? If we think back 2 slides ago, to record a SPITA, you have to have the right to use of a third-party vendor's subscription technology. If they're just providing support and maintenance services, they're not providing the right to use of an asset, so you don't have anything to record under GASB 96. I see this sometimes when organizations will have contracts like a maintenance-only contract for their copiers. They bought their copiers, and now they're paying that company an annual subscription fee to maintain all of those copiers and the related software that they're using, but it's just a maintenance agreement and not an actual software subscription. It also excludes things that are passed from one government to another government. We see this a lot of times when governments participate in sort of shared resources programs, such as a school district participating in ISD's shared resource program, or a city participating in a county's shared resource program, and they're getting software from that city or that county as part of that program. Now, just because you bought that software through the county or through the ISD doesn't mean that you don't have a SPITA. What it means is it really depends on exactly how that contract is worded, right? If you are just getting if the contract is between the school district and the ISD is paying the vendor directly, you probably don't have a SPITA because your contract is with another government. If you are just using their purchasing group power and you are contracting directly with the vendor, you probably do have a SPITA. So you really have to read that contract carefully and think about who's the party and the counterparty to this contract to really make the correct determination here. Also, anything that falls under GASB 94 and anything that's a perpetual license arrangement. I've seen a few of these where you bought the license, you have the right to use that software forever. That's a permanent capital asset for you when you first purchased it. But you pay them an annual software or a maintenance fee. That's not something that's going to end up being a SPITA, right? Because we already know that software maintenance fees would be excluded. Also excluded from the scope of this statement, anything that's short term, which means you have a maximum possible term of 12 months or less, or it's a rolling month-to-month or rolling year-to-year contract. Just in terms of the volume of SPITAs that we've seen this year, you see a lot of these annual year-to-year or rolling contracts where it's just, yep, we pay for this year's subscription, next year we'll pay for next year's subscription. So this helps us out a lot, especially when it comes to SPITA arrangements, because you end up scoping a lot of things out that aren't just long-term. It does include component contracts. A component contract could either be something where you have both support services and the right to use of that IT asset. I'd also say that the component unit contracts could be something that's split between a lease and a SPITA. You see this sometimes where there's software to support that lease. And so you really have to think about how are you going to split apart some of these agreements. Now, as much as it's practicable, the GASB would like you to separate the components of these into the software and hardware, or the software and the support component, and record these separately. There might be some situations in which you can't pull these apart. It's not practical. The company tells you that they don't charge you separately. They just charge you for everything. And so in those situations, again, you'll have to talk to your auditor. I will say the GASB's technical guidance on this tends to lean towards, if you can't pull apart the support and the subscription asset portions of the contract, you're going to end up just recording the entire thing as a SPITA instead of, unless you think that, oh, 90% of this is support and 10% of this is for the subscription asset. I don't think that's going to happen in too many situations. So what do we need to think about here when we think about what's the subscription term, right? So we know that one of the important things here is how long is that subscription term, because that's going to go into both our calculation of the asset and liability. It's also going to help us figure out whether or not it's even something we need to record. Well, the subscription term is all of the original non-cancelable periods to use in the contract. So let's imagine, we're going to go through an example of this in a second, where we'll sort of imagine what this might look like. But it's periods covered by, again, a one-sided termination. Remember back in PPP, I said you can have one-sided or two-sided terminations. That's just how I think about them in my head. If you have a termination or a renewal period where either the government or the vendor has an option to extend, or either the government or the vendor has an option to terminate, then you have to exercise probably best judgment here on whether you think it's reasonably certain or reasonably not certain to be exercised, and that will help us determine whether it's included in the period or not. However, if both the government and the subscription vendor, so imagine I'm the accounting director for the government and I'm trying to decide, I have the right to cancel it, or the SPITA vendor has the right to cancel it at any time, or with a 30-day notice or a 60-day notice. The maximum non-cancelable term is the term until we can both cancel it with sort of an unrestricted termination, i.e., it's not, you can cancel it because I didn't pay. It's just I can write you a letter and say we're done. And if that's 60 days at any time, then the maximum non-cancelable term is just 60 days. So anything where we fall into that sort of two-sided termination is going to hopefully end up being a short-term contract that we don't have to book a long-term asset and liability for. So let's do a quick example of how we might determine a subscription term for a SPITA. First, we're going to determine the non-cancelable period, and then we're going to start assessing our options when we get to those sort of renewals and/or terminations. So let's look at an example where the contract provides the government the control of the right to use of this IT software. Maybe it's financial management software for 3 years. After 2 years, the government can terminate that contract. And then after 3 years, there's an option to extend for 2 additional years. So these are sort of our facts and circumstances for the assessment, right? We've got an initial term, we've got something else that can potentially terminate after 2 years, and then we have an option to extend for some additional years. So how do we do the math here? Well, first off, the non-cancelable period, the period during which there are no options to terminate, are the first 2 years, right? Those are in for sure. We definitely have a SPITA as soon as we know that it has a 2-year term that's non-cancelable. Then we have a period covered by my option to terminate, and I don't think I'm going to exercise that option to terminate. So year 3 scoped in. Finally, we have 2 additional years where I have the option to extend that contract, and I am reasonably certain that I'm going to exercise that option to extend. Those are years 4 and 5. I'm going to add those in because I'm reasonably certain they'll occur. And we get to that total subscription term of 5 years. So in what situations might I reassess my subscription term? I might reassess a subscription term if the government or the vendor exercises an option that's not expected, the government or the vendor fails to exercise an option that is expected, or an event specified in the contract that requires an extension or termination of a contract actually occurs. Basically, if I was wrong at any point during my initial assessment about what will happen or what won't happen, we get to that point and we go, we don't have to go back and correct what we previously estimated. We just have to say, well, now that we know something about the facts of the circumstances, we thought we were reasonably certain. Turns out we weren't right. That's okay. We'll reassess that subscription term. So now I think we're on to polling question 2. How are you thinking about implementing GASB 96? We'll take a quick second break here to answer this question. All right, perfect. Hopefully everyone got enough time to answer that question. So next up, we've got to think, what are we going to put on our balance sheet here? Well, we're going to have a subscription liability and we're going to have a subscription asset that we have to recognize and measure. Those are sort of our two balance sheet components that we need to be concerned about. So, okay, so I know I need to put something on my balance sheet. What do I need to include in my calculation of what that subscription liability or asset are? Well, we always start with the liability side, and we start with the present value of payments expected to be made for the contract term. And we're primarily going to include fixed payments or payments that are fixed in substance. So for the most part, you're going to struggle most when you come to contracts where you have payments that are based on like a number of seats, right? Because the GASB specifically says no variable payments, and they also mention number of seats in their guidance. They say, well, if it's based on a number of seats, that's a payment that is variable. Well, that's sort of true. In reality, out in the real world, a lot of times you have to sign up for a base number of seats. And if you have a base, say we want 150 subscriptions to this, and they say you have to buy a minimum of 100, and then you can sort of fluctuate the additional 50 around it. Well, that base of you must buy 100 is a payment that is now fixed in substance if your contract is written that way. So it's not quite as simple as we just only scope in the license payments that we know are for one license, or we can scope out anything that's for multiple license payments. You really got to read that contract carefully and understand facts and circumstances to figure out what is fixed and what is fixed in substance that we're going to include. But we're going to need to identify three specific things, just like we did under GASB 87. We're going to need an interest rate, we need a time period, and we need to know what payments to include if we're going to do a present value calculation, which the standard does require. We've already talked a little bit about how do we calculate that subscription term. Now we're getting into what payments are included, and then we'll get into interest rate in a minute. There are some other payments that could be included in your subscription liability. You could have a payment for terminating that SPITA early that you thought you were going to exercise. Say this was rolled into your calculation of the subscription term. You got to year 4. You think, I'm reasonably certain I'm going to terminate then. When there's a termination penalty associated with it, that's probably something I should include in my calculation because that's what I'm saying is going to happen. If you have a contract incentive, if you have another payment from a SPITA vendor that you think is reasonably certain to be required. Again, these are less common situations, but if you do have these sort of conditional payments in your contract, you do have to evaluate whether or not you think they're reasonably certain or to be exercised, similar to how you were evaluating your subscription term. Finally, we get to sort of, okay, we have components, we have time period, we have payments, interest rate. Well, the GASB says, supposedly, if the vendor charges you an interest rate, you should be, and they're explicit about that in the contract, you should be using that interest rate to do the present value calculation. In reality, I don't think I've ever seen for a SPITA contract yet a SPITA vendor specify an interest rate, because these SPITA vendors aren't really treating these as though they're financing agreements, though the GASB wants you to consider it a financing agreement. So unlike some maybe copier agreements or bus lease agreements in previous years where we were under GASB 87, and even though they weren't finance purchases, even though they ended up being operating leases, you still had an amortization table or a percentage interest rate in the contract. You're going to find that that's not very common with most subscription contracts. So how do I estimate it? Same way we estimated it for GASB 87. We're going to look for our marginal incremental borrowing rate, basically creating an estimate of the interest rate that would be charged for borrowing subscription payments during the subscription term. For the most part, your sort of marginal incremental rate that you would use for term debt is probably a good place to start on this. Say you had a rate that your bond counsel said, well, if you were to borrow at 20 years, it would cost you this much in percentage right now. And then maybe you could sort of walk that back, adjust it for the fact that subscription periods tend to be much shorter than term debt does, say like 3 to 5 years instead of 20 to 30 years. And you'd say, maybe we'll kick that. Say they said your bond counsel said it would be about 4% for you to borrow right now. You could probably kick that up. Or I'm sorry, you kick that down because you have a shorter time period, hence a lower interest rate, and say maybe we'll use 3.5%. That type of logic and flow is something you really want to be thinking about, because you have to substantiate for your auditor that you've created a reasonable estimate of this incremental borrowing rate. Now, in practice, I'm going to evaluate your point estimate. Is it within a reasonable range? If you tell me it's 9%, I'm probably going to give you a pretty skeptical look. But if you tell me it's somewhere between 3 and 6%, I'm probably going to say that seems about right. Once we measure our subscription liability, we've also got to measure our subscription asset. First thing we do is we take that amount of subscription liability and we say that's the base value of our subscription asset. And in a lot of cases, that's where we'll end. We will simply say the asset equals the liability. That's where that's what we have to book. We've already done our present value calculation. But there are two other situations in which you could have an asset that's greater than the liability. You could have prepayments associated with that SPITA contract made prior to the commencement of that subscription term, or you could have capitalizable initial implementation costs. Now, this initial implementation costs section is where we vary the most from GASB 87. I'll talk about that in a second. But first, the one common situation we see with SPITAs is that often you go through your SPITA evaluation and you go, well, okay, but there's no fixed future payments to include because we made the whole payment up front. And that's where we get into this math right here, where you say, okay, well, now we just add that prepayment to the subscription asset. You basically then capitalize that cost as a SPITA asset, and there's no associated liability. Just makes it feel a lot like traditional fixed asset accounting at that point. And you don't have to worry so much about the creating a present value calculation for the liability, because you've prepaid this contract up front, and you just treat that cost. Instead of, like in the past, you might have expensed it, or you might have treated it like a prepaid and expensed it over the life of the contract. Now you just treat it like a capital asset. Finally, they say, remember, if you have a subscription asset calculated, you need to amortize that over a systemic and rational manner over the shorter of the subscription term or the useful life of the underlying IT asset. Basically depreciate it like a capital asset. They're just giving you a reminder that there's the potential that the useful life could be less than the subscription term, but it can't be more. You can't tell me, you can't classify all of your subscription assets as equipment and say they're a 7-year useful life, and then tell me that the subscription term for that liability is 5 years and your useful life for that asset class of assets is 7 years. That's not going to work. The most it can be is 5 years. You can tell me that the asset was going to be lived shorter. I would also maybe give you a skeptical look at that point and say, why are you paying over 5 years for an asset that you're only going to use for 3 when it's subscription technology? That doesn't make a lot of operational sense, but that could be a theoretically appropriate accounting treatment, whereas 7 years to 5 years would not be in that situation. Finally, when might we remeasure the subscription liability? Well, again, the rules are going to be pretty similar to GASB 87. You have a change in the subscription term. There's a change in the estimated amounts already used in the measurement of that liability. There's a change in the explicit stated interest rate that the vendor is charging you if you were using an explicitly stated rate as the initial discount rate, and or either subscription periods or amounts that we previously thought were contingent become reasonably certain or cease to be reasonably certain. So again, any of these key inputs that we were estimating up front, there's a change in those, or there's a new contract modification, we would have to remeasure our subscription liability. Just because we have updated our estimate of our incremental borrowing rate doesn't necessarily mean that we have to go back and remeasure, i.e. we get to year 2, you tell me your incremental borrowing rate is changed by roughly 1%. I say, that's great. I'm glad you're thinking carefully about this. For any new SPITAs, you'll use your new incremental borrowing rate, but just because you have a new incremental borrowing rate estimate doesn't mean you go back and you'll remeasure your existing ones. So finally, let's get into really quickly outlays other than subscription payments, including implementation costs. The GASB says, and I'm expecting this only to apply to implementations that are significant, that are big implementations. It's more than just I got a software license and I'm logging in and I have a new subscription. This is like we have a big project to install some new subscription software. The GASB gives us some rules about what costs related to that project can be capitalized as part of that subscription asset. We can't do anything from the preliminary project stage, basically the RFP stage, right, where we're designing, we're formulating and evaluating alternatives. We're determining what our needs are as part of our IT process. Can't capitalize that. You can capitalize any implementation stage costs necessary to design, configure, code, or install, test, convert data, anything that's actually part of our implementation of placing that subscription into service. Should be capitalized as part of that asset. Once we finish that implementation and that subscription is in service, that module is in use, additional training, additional data conversion beyond just the basics to make the underlying asset operational, or additional software maintenance isn't going to be capitalized. That'll just be expenses incurred. So just this middle portion is what's possible to be added to that potential subscription asset. Now, I want to give just a brief visual of this and what the accounting for this might look like in sort of a brief amortization table. You have here a subscription liability. You've calculated, you did your present value calculation. You'd add in any payments or prepayments before the contract started. We'd add in any capitalized costs that we'd identified as part of our implementation stage. And you can see in this example, there aren't any for both of those two, because this is just a basic standard. The asset is equal to the liability. Then we take it up to the top of our amortization table and we'd amortize it over the 6 years associated with that subscription asset. So just trying to give you a visual of what this might look like. I'm a visual guy. I like these explanations. So I think we're on to polling question number 3 now. COVID and new GASB standards have had, I think, a significant impact on everybody and their audit cycles. With respect to your 2024 audit cycle, how are you feeling? Are you feeling optimistic, unsure, concerned, or maybe you just don't think about me until I actually come out and do your audit each year? All right, onwards and upwards. Accounting treatment and financial statement disclosures. Just like GASB 87, from the lessee perspective, at inception, you're going to need to create a capital outlay and a proceeds in modified accrual accounting funds, so any governmental funds in which you are recording a SPITA. You say, Dan, why is that? For most of these situations, I'm going to incur an equivalent expense and an equivalent other financing source. Why do I need to gross up revenue and expense? Well, if you think about the entry that's required, right, you need to debit an asset in your GASB 34 fund, and you need to credit a liability in your GASB 34 fund, and you need an offsetting debit and credit to eliminate in your GASB 34 fund, just like any time you're setting up a long-term asset and a long-term liability for your government-wide statements. So in any governmental funds, you're going to need that revenue and expense, or I'm sorry, other financing source and expense to eliminate for your government-wide statements so that you can record that asset and liability on your books. In the notes to the financial statements, at least our standard note, and in fact, I think everyone's standard note that I've seen, it's going to look very similar to the note disclosure for GASB 87. You're going to disclose the general basis, terms, and conditions for any SPITAs that you've identified. You're going to disclose any total subscription assets and accumulated depreciation. Now, that's generally done I've seen it done multiple ways, but it's generally done just as another line item in your capital asset note, so as not to create a lot of additional lines in your financial statements. That's how we're generally doing it now. And you also record any current year outflows for variable payments that weren't previously included in the subscription liability. I would expect this only to be the case when there are significant variable payments, i.e. you identified a SPITA, you didn't have much to include in your SPITA calculation in terms of fixed payments because a huge portion of that contract was variable and it was a huge contract, then you should still be disclosing those variable outflows in the footnote. But again, it'll look a lot like your lessee footnote for GASB 87, and the disclosures should be fairly similar. You'll also disclose any current year outflows for other payments not previously included in the subscription liability. We saw some of this with GASB 87, where the lease of the lessor came back and there were other outflows that weren't previously included and was adjusted. That does happen year two. You disclose principal and interest requirements to maturity. Again, this is that sort of 5-year table similar to what you see in debt. That's part of why we have to do a present value calculation so that we can separate the components of future payments that are principal and interest. And then we disclose that for the first 5 years in single-year increments and then in 5-year increments thereafter. Also, we disclose any commitments. So if you signed a contract but hadn't actually had any expenditure or outlay, if there was a significant commitment, like you're going to enter into a contract for a huge new SPITA, you might have to disclose that, similar to capital asset construction commitments. And any components of an impairment loss if you were to have one. I'm hoping and thinking that from a rational perspective, from a practical perspective, impairment losses should be fairly rare unless you had some legacy system that you're still paying for that you can't use, that you had to record, and you couldn't get out of that contract. Hopefully that's not the case for most organizations. You could also potentially have a prior year restatement. This would be in the situation where that asset is not equal to that liability, either because you had a huge prepayment or because you had additional implementation stage costs that you wanted to capitalize at the beginning of your implementation. Generally speaking, I think that this is usually better addressed by simply doing a past adjustment if you end up having an effect on beginning fund balance or beginning net position, I should say, for the asset and liability at the government-wide level. So rare, but it is possible that you could have a restatement if you had a huge amount of assets and not much in liability. Finally, some practical considerations here, and I'm going to say this about a lot of these statements in case you're getting nervous about, oh, how much work am I going to have to do with this? Never apply anything for immaterial items that you don't have to, right? Which means that you don't have to apply the standards of this statement if, say, you've set a reasonable capitalization threshold and you have items that are under that capitalization threshold, or you've talked to your auditors and said, we're such a large organization that this is just immaterial to us. Usually the best way that that's communicated back and forth is by setting a reasonable capitalization policy, which we'll talk about in a minute. But don't, as Stephen Bland used to say, don't sweat the small stuff. A couple of other practical considerations. I've got a full document, which I'm happy to share with anyone that is interested in reading it, that goes kind of in detail about what an implementation timeline for a SPITA implementation might look like. It kind of goes into 3 main stages, stage 1 being gathering and compiling all of those contracts. So thinking about all of the decentralized places where data might be maintained or warehoused outside of central accounting, which is maybe the scariest thing, I think, for all of us who are in central finance. Thinking about GASB 87 or 96 is what might be out there that we don't know about, and trying to compile that information. You also want to be thinking about analyzing your revenue and expense accounts for things that might contain potential SPITAs, primarily your expense accounts when it comes to SPITAs, revenue accounts as well when it comes to leases. And I recommend that because, well, that's what we're going to do as your auditors when we come out to try to make sure that you've identified a complete population. So why not go ahead and do some of that expense analysis beforehand so you're ready for any questions that we might end up asking. Stage 2, evaluate those SPITA agreements, i.e. read through that, compile that list. Usually I prefer an Excel document talking about the counterparty, you know, how much we're paying them, what the terms are. So you can kind of see that list of what do I have to deal with. So I can list, okay, this is clearly short term, this is clearly small stuff, and then I have to worry about these other line items. We've got a spreadsheet you can utilize to help sort of think about what are the important components of any contract you need to look at. You could also use, you know, your own internal spreadsheet. There are some available from major vendors like DebtBook, but in some way, shape, or form, start tracking and evaluating what SPIDAs might be out there. Then determine an implementation timeline for calculating, recording, and reporting those SPIDA assets and liabilities. This often can be fairly time-consuming. There are a lot of manual Excel-based tools out there. Again, we've written one that you can use for basic implementations. If you end up with a list of SPIDAs that's 3, 5, 10, anything more than like a very small handful, you really want to be thinking about what software solutions are there out there, such as DebtBook or maybe LeaseQuery, for calculating and recording these assets and liabilities. And I say that because you really don't want to get bogged down in a bunch of manual calculations for dealing with a lot of these. And this standard isn't going away. This might be year one, but we're going to be doing this every single year as far as hopefully my career continues in governmental accounting. That I think just covered what's on this slide, but also a reminder to be thinking about this timeline and preparation and getting through the phases of implementation before your auditors get out on site. If I show up and you say, I haven't thought about potential SPIDAs yet, I'm going to say, you're probably not fully prepared for this audit, and that's probably going to impact your timeline for completion and reporting. There's also some guidance available for determining an incremental borrowing rate. The GASB specifically points out in 96 and 87 that there's guidance in GASB 62 about determining and documenting an appropriate incremental borrowing rate. So if you're curious, you really want to write out your documentation for that clearly on how you determine inputs and establish a reasonable rate. Look at the GASB 62 guidance. There's also some spreadsheets available from major software vendors like LeaseQuery, et cetera. Though I think those are probably a little bit overkill for most governments that aren't operating leases as sort of part of their primary operating procedure. Generally speaking, if you haven't established one or a small handful of incremental rates to specifically address one or a couple of SPIDA classes, you'd be fine and wouldn't necessarily need to establish an incremental rate for every single one, which is, I think, how the LeaseQuery template suggests you do it. Finally, I think this section has brought up a lot of questions about capitalization policies. What's an appropriate threshold? Remember I said earlier, don't have to apply to immaterial items, and that the best way to communicate materiality back and forth between your auditors and your organization is having a clear capitalization threshold. Well, you can consider writing leases and SPIDAs into your existing capitalization policy, including some specific like thresholds. It doesn't have to match your existing capitalization threshold. In fact, the GASB suggests that not just leases and SPIDA, but a lot of different asset classes could have their own separate threshold if in situations where it's appropriate. So you don't necessarily need to say, well, my organization's threshold is $5,000, so leases and SPIDAs are also $5,000. That's practically expedient. It's not necessarily the only option. It's not even necessarily the recommended option in every situation. So love to have a conversation with you about capitalization policy if that's something you're interested in. But thinking about this in advance is helpful in figuring out what do I have to address and what do I not have to address. There are also some important elements to think about when you're setting a capitalization policy. And I point this out because I don't want everyone to go back and think, all right, I have to set $5,000. That's what it is. No, in fact, a capitalization policy should be set based on a number of factors, including things like quality, application, and environment. And this is where I'll plug the GFOA's, well, should I call it new? I don't know if we can see it. Somewhat new, Accounting for Capital Assets, 2nd edition. This book gives a wide amount of resources on thinking about what capitalization policies should look like. And it also has everything from the journal entries to record capital assets down to sections where you can test yourself about what should be included. It specifically addresses GASB 87, 96, 94, and I believe Chapter 9 is a deep dive about selecting capital asset accounting systems and about setting capitalization thresholds. So that's a great resource when you're thinking about what your capitalization policy should look like. Also point out that I think some governments that I worked with last year hadn't properly or fully addressed the implementation guide clarification that came out as part of 2021-1, talking about situations in which you're buying a group of assets and thinking about those assets and the acquisition costs for them as a whole, instead of just, well, we bought 60 laptops and each individual laptop was under our threshold. The GASB actually changed their recommendation on this back in 2021 and said, we really think you should be considering those in the aggregate, and if they're significant in the aggregate, not just if they're significant at the individual asset layer. All right, I think that brings us on to polling question number 4. And with respect to recently issued and upcoming GASB standards, how do you feel about those? Do you think they're providing good cost benefit? Are you tired of this already? All right, onwards we go. So I'm going to spend a little bit of time here talking about GASB 100, accounting changes and error corrections. Now, if you've heard me talk in the last couple of times through, I've said this is probably not a standard you need to spend too much time worrying about. And I still sort of agree with that, but there are some situations in which it will probably affect financial statements for most organizations, just in terms of how your reporting looks. This is effective for fiscal periods beginning on or after June 15th, 2023. So it will start with our June 30th, 2024 year-end audits and will be implemented after that, though they do suggest early adoption. And also, we'll see this when we get to GASB 101, but this is sort of the GASB's comprehensive guidance for how do you deal with a change in accounting principle, a change in accounting estimate, or an error correction, or even an implementation of a new GASB. And so future standards may just reference this GASB instead of giving specific guidance about how to implement as of the earliest period, et cetera. It's going to talk about, well, 3 really specific areas. Reporting, which is recognition or display, i.e. how do we put it on the face of the statements? Disclosures, what things do we need to put into the footnotes regarding a change in principle estimate or a correction of an error? And how should we address those specific things when it comes to the required supplementary information disclosures? So changes in accounting principle, change from one GAAP principle to another, specifies that principle should be preferable in understandability, reliability, relevance, timeliness, consistency, or comparability, i.e. we really think this thing is better. We're not just changing it because we wanted to change it. And it's going to be the default treatment for new GASB pronouncements going forward. Could also be something like we changed from LIFO to FIFO for inventory measurement. That would be a change in accounting principle as well. You could have a change in accounting estimate. This won't result in as much disclosure. It's just giving us the rules for what should we do with a change in accounting estimate. There are changes in the inputs for the estimate, result in a change in circumstance, new information, more experience, and or general guidance applies in the absence of specific guidance, i.e. for situations where you're changing actuarial assumptions. I think mostly what the GASB is doing here is trying to define what constitutes a change in accounting estimate, so we don't too broadly scope in things that we might have previously said, oh, it's just a change in estimate. They're saying this is what a change in estimate is. You can't tell us it's these other things as well. And finally, the one other than corrections of an error that I think will affect us the most, changes to or within a reporting entity. Now we're going to have to do some additional reporting or disclosure if we add or remove a component unit, if we reclassify a component unit from being blended or discretely presented, and maybe the most irritating ones, if we add or remove a fund or reclassify a fund between major and non-major, we're going to have some additional financial statement disclosures to deal with. So let's talk through recognition and display, and then we'll get to some examples of what this might look like as well. Kind of reinforces probably what I think almost all of us were already doing, is that we need to display the aggregate amount of the adjustments to, or the restatement of beginning net position, beginning fund balance, or beginning position collectively is how they refer to it in the standard, as applicable for each reporting unit. Basically just explaining that if you restate beginning fund balance, you have to display that in your financial statements. It's now part of this GASB. When you have changes in accounting principle, those changes are retroactive. For single period financial statements, you restate beginning position for the cumulative effect of the change on the prior period. For comparative financials, you restate the financial statements for all previous periods, including the first period presented. This isn't necessarily any different. This is just taking it out of the individual standards, where in 87 we said if this is how you implement, 96 we said this is how you implement. Going forward, the GASB just wanted to put that in GASB 100 and say, well, if you have a change in accounting principle, which includes changes in GASB standards, we're always going to do it like this. We're not going to rewrite it out every single time. So this is what we've already been doing, not a change to existing procedure. You could also have some changes in accounting estimate. Again, these are prospective, recognized, effective in the period of change. This is not a change to how we've been handling historically changes in accounting estimate. It's just a codification of that thing. Changes to or within the reporting entity will also be prospective. We'll adjust the current period's beginning position for the effect of the change, and as if the change occurred at the beginning of the reporting period. So one period, no look back before that, and I'll show you what that looks like in just a minute. And finally, the GASB also codifies in Statement 100 what is a correction of an error. It's a mathematical miscalculation, a misapplication of accounting principles, or an oversight or misuse of facts that existed as of the time the financial statements were issued, or could have been reasonably expected to have been obtained or taken into account before the financial statements were issued. Now, you're going to say to me, Dan, I would never do such a thing. We'll never have a restatement. I would say, we hope so. We certainly think all of our clients do a great job identifying the relevant facts and circumstances, and we try to make sure that there's never anything mixed. But the GASB gives some examples of situations in which I could reasonably see someone missing, and we'll get to those in just a second. The recognition and display should be retroactive, should restate the beginning net position for the cumulative effect, should restate financial statements for all periods presented, should restate the beginning position for the first period restatement for any cumulative effect. So basically, all the way back to the first period that we're presenting in these financial statements should be restated for the correction of that error. So here's a brief look first at what might it look like for a change within the reporting unit for a fund that was previously major and is no longer major. I don't love this. I don't like how it looks, but that's just because I'm used to the way that we have been doing it. So this is the GFOA's example of what this would look like if you had a change within a reporting unit from major to non-major. Basically, you have to leave that placeholder column in, show an adjustment from changes from major fund to non-major fund. And they're saying that, like, you need to show this columnar format between your total governmental funds and your non-major funds. So I don't love this presentation. It's going to mean that discussions between clients and the auditors regarding what's major and what's non-major is going to be a little bit more significant. I'm going to skip forward and just talk about an example that they give. So there are a couple of, let's talk about 3 examples. One is where QRS Foundation no longer meets the requirements for presentation as a blended component unit. So the City Council passed some new legislation. You have a component unit that's no longer a blended component, it's now a discrete one. So that's example A. We're also going to have example B. XYZ Foundation now meets the requirements for inclusion as a discretely presented component unit. And example C, we identified a correction of an error. And we're going to take those 3 examples And we're going to look at sort of the columnar presentation that they'd like us to disclose in the notes when you have a change within the reporting entity because of a blended becoming a discrete, a new discrete, and an error correction. So you can see business type activities and enterprise fund, that QRS foundation is now being removed and added in as a discretely presented activity. It was previously presented within an enterprise fund as a blended. You have a new foundation presented as a discrete here, and you have your error correction. Now you said, Dan, you said you were going to talk about situations in which you might have an error correction. This is one situation where there's donated capital assets, donated infrastructure. I can absolutely see in some situations where this infrastructure asset donation was handled by a decentralized department that wasn't central finance, city administrator, building department, happened at the last minute. They signed the deal, should have been reported. It would have been, of course, a capital contribution and then a capital outlay, and then it should have been capitalized and wasn't reported. So here we see that error correction showing up only at the governmental activities level. That's the type of thing where we have decentralized information that could get missed and was misreported, and we'd have to correct that as an error and display in this columnar format going forward. It also gives us rules and guidance about changing RSI. Basically, for changes to or within a reporting entity and changes to accounting principles, we're going to report in the RSI in a manner consistent with the basic financial statements. For years not presented in the basic financial statements, we're not going to bother to restate the information presented in RSI. We might just explain why that earlier information is not consistent. I think this treatment is consistent with how Raymond has always handled changes in MD&A and in supplementary information when it comes to ACFR presentation. So I don't think this is anything that is going to throw us off, and hopefully not you guys either. Finally, correction of errors. They want you to restate all periods if applicable and practicable, and or explain why it's not practicable to restate if that happens to be the case. Again, never forget the 12 most important words of any GASB statement. We aren't going to be applying these provisions to immaterial items. I would think especially when it comes to restatement or correction of an error. Unless an error is material, it's probably either going to be a past adjustment or a non-disclosure. We really don't want to be applying the standard in situations where it's not needed. All right, so now to GASB 101. This one's going to be first into place for our December 2024 year ends and our June 30th, 2025s after that. And I think this is maybe the one that a lot of clients are most interested in, because it's not just a reporting thing, it's a change in some reconciliations, and it's a change in recording liabilities. So GASB said basically, we need to revisit GASB 16. Under GASB 16, the GASB stated that only things that should be cash payments conditioned on the employee's termination or retirement should be included in compensated absences. Now, this is how we've been dealing with compensated absences for years. This is how probably all of your existing compensated absences calculations work. You're looking at your contracts, at your provisions, at your bargaining units, and going, what would I have to pay out to that employee on termination? And that's how we're going to calculate our liability for compensated absences. Now under 101, this now breaks it into two components. It could be something that's compensated during termination of employment, or it could be something that's actually used during the term of employment. So definition of compensated absences, hopefully we're all familiar, but just to refresh, could include vacation leave, sick leave, paid time off, holidays, parental leave. All of these things are potential compensated absences. There's also some specific guidances about sabbatical leave. Get to that in a second. That's probably less applicable to the local governments on this call, and more applicable if you're a higher education institution that's reporting under GASB. What are the rules now? Well, now the rules are you should record a liability or recognize liability for leave if it's attributable to services already rendered, if that leave accumulates, or if that leave is more likely than not to be used for time off or otherwise paid in cash or settled through non-cash means. We're going to get to an example of what this looks like in just a minute, don't worry. But it does mean that we're going to have to do an analysis, right? It's more likely than not, hence some type of judgment is going to be used here. It's not just a yes or no, paid or not paid like it used to be. What's more likely than not? The GASB says you've got basically 4 factors that you should consider. The government's employment policies related compensated absences. Of course, we've always looked at those. Whether leave that has been earned is or will become eligible for use or payment in the future. And historical information about the use, payment, or forfeiture of compensated absences. That's going to heavily factor into our sort of example analysis moving forward. Finally, the GASB reminds us that if the information known to us now indicates that our historical trends aren't accurate, we need to include that in our analysis of what we think will or will not be used. We can't just say the historical pattern is X. If we have some knowledge that the historical pattern is misleading, we should include that in our analysis going forward. What pay rate should I use to recognize this liability or to measure this liability? It's not going to change. It's going to be the pay rate used as of the date of the financial statements. There are some specific other criteria. There's some subcategories, but by and large, it's still going to be that pay rate as of the date of the financial statements. What if I have some weird provision where my compensated leave converts into benefits for the DB plan? We aren't going to include anything like that as recognized as a liability for compensated absences. Supposedly, anything that's converting to benefits for a DB plan, a pension plan, an OPEB plan, should be already included in the net pension liability, i.e., it should be being taken into account by your actuary, basically just like they have estimates of what compensation will be. If you have rules about converting paid time off to a defined benefit contribution amount, that should be already factored into your net pension liability assumptions and calculations. And so we don't effectively want to double count that by saying, oh, we were going to record it under a GASB 101 liability and a GASB 68 or 75 liability. Could there be compensatory time for potential leave? Sure, we could have military duty, jury duty, something else that's a sporadic leave opportunity, but we shouldn't necessarily recognize that as a future liability until the leave commences. So if you have people currently out on military leave or currently out for jury duty as of year end, you would include that in your liability balance. But just because you've got something in the future that you think might be recognized doesn't mean we're going to have to guess at what that sporadic leave might look like if it's not accumulated and not banked. There are also some specific rules that apply to sabbaticals, which might affect our higher education clients more than it will affect those of you working in local government, just because of generally what's granted to different bargaining units. But in situations where you have an unrestricted sabbatical leave where the employee is required to perform duties, generally speaking, that's not going to, those are going to be two different things. An unrestricted sabbatical leave is probably a compensated absences. They're not required to do anything for you to earn that leave, so you are compensating them for being absent. The standard takes a different view of situations in which you're required to perform teaching duties during that sabbatical, and they say basically just because you're doing research on your sabbatical instead of teaching, you're still performing duties as an employee. That's not a compensated absence. So you can't just take all sabbatical leave and apply this. You'd have to separate it into different types of sabbatical leave before making your compensated absence calculation. So what about unlimited leave policies and holidays? So leave that employees are able to take as needed without specific limits. Holiday leave that's taken on a specific date that's not at the discretion of the employees. Those things are not things that you need to consider as part of your liability under GASB 101. Those are specifically excluded. So if you have an unlimited leave policy, I can't say that I know of a lot of local governments with an unlimited leave policy. And any holiday days that you've approved for specific dates, those are not required to be taken into consideration for the calculation for GASB 101. What will this, what impact might this have on the presentation of financial statements? Well, for one, we're no longer going to have to sort of make that funny estimate of what did we add and what did we dispose of during the year, similar to how we present long-term debt. Instead, we'll just say, this is what the liability balance is this year. This is what the liability balance was last year. That's it. Show me the net change. We're good. I love this. Simplifies things, I think, and sort of stops confusing the situation, because of course your adds never ended up to your deletes, because even if you have the right amount of time taken and used, you're measuring the beginning liability as of a different pay rate than as of the ending liability, so you end up having some fudge factor in there. The math doesn't math. I like this very much. And as we mentioned back talking about GASB 100, this statement does reference back to GASB 100 and notes how you need to implement the standard. If you're presenting comparative, you'd have to restate beginning as of the earliest period. If you are presenting a single period, you should restate beginning net position if practicable. So there will have to be some consideration for that change. I would hope that in a lot of situations, we'll do this calculation. Maybe it'll be close enough that we can do a past adjustment instead of a full restatement, but there will be probably a lot of discussion around doing the calculation for this year and for the previous year. So let's dive right into an example and give us some facts and circumstances where we can look at an actual example of calculation for this. So in this example sick leave policy, employees earn 1 sick leave for each month worked that can be carried over to future years. Employees that have a service years of 10 or more are paid in cash for 30% of their unused sick leave, maximum of 150 days upon termination for their hourly rate at the time of termination. And the government does not contribute to the defined contribution plan for amounts paid out at termination. So we'll see all these factors taken into account in the calculation in a second. We also have some basic assumptions. Sick leave policy is consistent for all governmental employees, and we're also going to use rounded numbers. In this calculation example, this is, again, just one possible way to do this. We're going to calculate the amount more likely than not to be paid by the aggregate employee group. We're going to calculate the amount estimated to be paid out at termination for the aggregate employee group. So those are in any of the examples that I've seen thus far, whether it be GFOA or anywhere else. We have to have these two components now. Calculate the amount more likely than not to be paid out, more likely than not to be used by, and calculate the amount estimated to be paid out. So we're going to try to develop an analysis here that does both of those things. We have some key inputs, some important things we need to know. I'll go over these as we go through this calculation. Average days used annually for a sample of active employees. We need to know the average hourly rate. We need to know the percentage that's applicable for salary-related payments. We need to figure out what the aggregate sick bank for the total and active population of current employees is. And we need to know the number of days paid out and the total days accrued at the date of termination for a sample of former employees. So let's just think critically about this for a second before we look at the example. Average days used annually for a sample of active employees. We're going to have to sample some active employees and do an analysis. Average hourly rate for sampled employees. We'll take our sample employees, we'll do an analysis. Percentage of applicable payments for salary-related payments. We're going to get that from our rules on payout. Remember, on a previously slide, we said certain things get paid and certain don't. We'll see that in our example. We'll need our total sick leave bank number for total accumulated days for the entire active population. Hopefully, we could just run a report and get our total sick leave bank days for the entire unit or organization. Finally, number of days paid out, total days accrued at the date of termination for a sample. We'll get that from our analysis. So, possible sample analysis here, where we're calculating the average days and we're calculating the average hourly rate so we can use this in our possible calculation. You notice that we have a sample here. We have 10 employees. Unlike previous methods for calculating compensated absences, we aren't taking every single employee. This GFOA example takes only a sample of about 10 employees. Now you might say, Dan, I don't know if 10 is the right number, and I don't know if 20 is the right number. How do I figure out what my sample is? Well, there's no hard and fast rules on this. It's gonna have to be an analysis. The most important thing here is we try to create analysis that's representative. And so we're gonna have to think critically and be, more than just bookkeepers. We're gonna have to be analysts when it comes to the standard if we're going to use a sampling methodology. So here we have sampled 10 employees. We've taken for the last 5 years their average days used, and we've taken we've figured out the total number of days used and divided by their annual average usage, come up with employees tend to use of the 12 days awarded about 40%. I would think that in real life this is going to be higher than this sample usage. Certainly, I would hope that most employees are taking most of their days off, especially if you average it out over 5 years. I would think that in a lot of cases, this will be like 75% or higher. Maybe in some cases, it'll be close to 100. Average hourly rate, again, this is where we're real concerned. Hopefully, this is a representative sample of annual salaries for the organization. We see we have some much higher, some much lower. This is a state in which you really don't want to skew samples with outliers, so we're really going to have to think critically about how we're going to determine that average hourly rate if we use this type of a sampling method. Then we're going to calculate our salary-related payments. Remember, earlier on, we said that the organization does not contribute to their DC plan for leave that is paid at termination. This is leave that is used. This is leave that is paid at termination. So our percentage calculation on salary-related payments like FICA and DC plan contributions is going to be different for our two calculations between leave that is taken and leave that is paid out. In step 3, we're going to have to figure out a percentage to apply to our second part of that calculation. We're going to sample some former employees. We're going to look at days paid out on termination. We're going to look at the accumulated unused days, and we're going to come up with a percentage. Interestingly, this percentage would be even higher if this one employee hadn't had days paid out at termination of 0. They lost all of their accumulated days because they didn't have enough years of service likely. So again, we'll have to think when we think about our samples, are we getting a large enough sample to be representative and hopefully not skewed by just, an outlier employee failing to get paid out at termination. Then we have to do 2 calculations. We have to do our calculation related to sick leave to be used. And in this calculation, we've got our total bank days, our percentage used, giving us our sick leave more likely than not to be used. Our average hourly rate gives us our liability for sick leave before salary-related payments. And then at times our 1.265 factor, that's going to get us our total liability for sick leave to be used. Now, I'm going to go back here real quick so that I'm not going too fast and point out where these numbers come from. Our 38.67 number comes from right here from our earlier analysis. Our average hourly rate also comes from this analysis. Our percentage for leave that is used for salary-related payments, that 0.1265 number comes from right here, our analysis of salary-related payments. And that brings us to our total liability for sick leave to be used. So that's part 1. Part 2, we're going to take our maximum sick leave days. We're going to multiply that by the factor that we determined previously, that 84%. Let's go back 2 slides. Here's that 84% that we found in our sampled analysis of former employees. We're going to multiply those together, cap our sick leave for pay, capped at 30%. Remember, this was one of our rules on our facts and circumstances slide. And we're going to come up with a salary-related liability for sick leave for payout. That's remember, this doesn't include DC payments, so it's 0.0765 and not 0.1265 from a previous slide. And that's how we're going to calculate our total liability for sick leave to be paid out. Remember, we add these two together. So if you add that 206,303 to the 78,892, that gives you your total liabilities for compensated absences. Now, I know that's a lot. But I just wanted to run through an example calculation. Now I'm going to try to talk big picture here for a second about the many ways in which you could do this. This is just one GFOA example. GFOA also gives two other examples, one with an average remaining service lives set up where they're doing a historical analysis of only former employees instead of using current active ones. And they also suggest the dollars paid method, where you focus less on the experience of hours used and more on dollars paid, and you use that to drive your analysis of what you record as your compensated absence. All of these come up with a slightly different, they're similar numbers, but slightly different ones. There's no authoritative guidance on exactly how you should approach compensated absences. There's no authoritative guidance on exactly how you should sample if you were to use one of these example approaches. So there are going to be a lot of opportunity for discussion around this one. So you really want to start thinking about how you might do this now, as opposed to thinking about it for your either December 31st, 2024 audit or your June 30th, 2025 audit. Look for an approach that's efficient from a time-saving perspective. If you have a huge population of compensated absences, a sampling approach might make your calculation easier each year, assuming you give reasonable thought to how you are developing your sampling methodology and that it's representative. If you have a very small compensated absence population to begin with, you might not want to sample. You might continue to use your existing template and simply update it for to try to do a brief analysis of historical usage for those employees, and simply do our two calculations for amounts used and amounts paid in that existing spreadsheet. And or you might end up with a less substantial adjustment to your existing work if you have a sort of smaller existing population of employees to consider. Couple of final reminders on this standard. No expected major changes to vacation time, which is usually paid out on termination. Sick leave that accrues and does not have a payout mechanism will result in a liability. It just won't result in a termination liability for the amount, more likely than not to be used in a future period. Don't forget to accrue liabilities for things that are dependent on sporadic events when they actually commence. So if there's someone that's actually out on leave at year end, you would have to include that liability, just not for someone that you thought they might go out on leave for jury duty, military duty, something like that. And remember, as always, if benefit practices or working conditions change, get familiar with those policies. Don't get blindsided because there's a huge change in your bargaining unit agreement. You didn't expect it, and all of a sudden you have to redo all of your work. So I think we're now on to polling question number 5 here, which is our last polling question, which is about the standard we're about to discuss, which is GASB 102, certain risk disclosures, which we're going to talk about in our remaining 7 or 8 minutes. All right, GASB 102, certain risk disclosures. If you're at one of my presentations in the fall, you heard me talk about this standard as an exposure draft. Well, it was issued in December of 2023, and it's going to be effective first for fiscal years ending June 30th, 2025. So we got a little bit of time on this one, just like we have a little bit of time on our compensated absence standard. Why did the GASB revisit this particular topic? Well, the GASB went, we just had this huge possible risk disclosure, COVID-19 pandemic. We have some differences between how the FASB addresses this and how the GASB addresses this. And there's a prevalent use of estimates in governmental accounting and reporting for all types of things, whether it be net pension liability, net OPEB liability, compensated absences, capital assets. And many of these estimates, or maybe a future landfill closure, something like that, could be affected by a potential risk disclosure, whether that be a concentration or a risk uncertainty. So in this particular standard, they address risks, uncertainties, specific disclosure requirements and criteria associated with disclosures. The GASB gives us two key terms in the standard to describe what risk disclosures might look like. They talk about concentrations and constraints. Those things that might pose a risk to a government with respect to raising resources or controlling spending, or something that might affect a government's ability to provide services at the level of which they've been previously provided, or meet obligations as they come due. We can think of all sorts of examples of this. Concentrations might include employers, industries, things that lead to significant inflows of resources or revenue, situations covered by collective bargaining agreements regarding workforce, providers of financial resources. I mean, if you think about just how the economic state is in the state of Michigan, if the University of Michigan were to suddenly close half of all operations, it would have a massive effect on every county, school district, city within Washtenaw County and the surrounding area. Same with a major collective bargaining unit for a government. If appreciably all of your workforce is covered by one or two major bargaining agreements, and those agreements are on the table, and situations are contentious, that could certainly pose a concentration. We'll talk about that specific example in a minute. And then if you're having, the government is having a very difficult time procuring material, labor, or services, and say you're a water and sewer authority, you can't get your hands on the amount of aluminum or steel or other input materials that you need to put into your major piping projects, that could end up being a possible concentration as well. A constraint might be a limitation by an external party that includes and is not limited to a limitation on raising revenue, limitation on spending, limitation on the incurrence of debt, mandated spending. Common example in the state of Michigan could be most governments can't incur more than 10% of their taxable value in terms of debt. I don't know many governments that actually come anywhere close to that, but definitely if you were at 9.5%, and you were really constrained in your ability to issue new debt because you were about to hit that threshold, you would probably have a constraint disclosure to be considering. So in what circumstances might we actually have to disclose a concentration or a constraint? Well, if it's known to the government prior to the issuance of the financial statements, that's step one. If it makes the reporting unit vulnerable to the risk of a substantial impact, that's two. And if the event or the events associated with the concentration or constraint could cause a substantial impact and have occurred, begun to occur, or are likely to occur within 12 months of the date of the financial statements, that's part three. So we know about it. It's going to have substantial impact. It has either occurred or it's going to occur within 12 months. We probably have a concentration or a constraint risk disclosure to make. The GASB does offer a consideration for mitigating circumstances, but they say if only for mitigating circumstances for which actions have been taken prior to the issuance of the financial statements. So you can consider mitigating actions taken by the government that might cause the government not to meet this disclosure criteria on the previous slide, but only if those actions have already been taken. Just because the government has developed a plan for how they're going to address this concentration or risk disclosure doesn't mean that they no longer have to make a disclosure about this concentration or constraint. It just means that there might be mitigating circumstances to either disclose, or the mitigating circumstances might make it so that the government no longer meets this disclosure criteria. So let's look at an example. If as of December 31st, you have December 31st reporting unit, and for that reporting unit, Sample Transportation District, almost all of their workers are members of the State Association of the Transportation Workers. They have an existing 5-year labor contract that expires on June 30th. Negotiations on that new contract have been contentious and ongoing since September of 2021, let's assume. The transportation workers are responsible for appreciably all of the day-to-day operations of the transit system, including all of their operational services. So in this illustrative disclosure, assessment of disclosure criteria were assessed for the primary reporting units. The district did not report any revenue debt in other reporting units, so it's restricted to just the original reporting unit. All transportation workers employed by the district are subject to a collective bargaining unit, so it does seem like a concentration. It does seem like it meets our disclosure criteria. Is it vulnerable? Does it make the organization vulnerable to the substantial potential impact? Management of the district has determined that this labor concentration would make them vulnerable, would potentially result in significant interruption of services, and could possibly cause a substantial financial disruptive impact on the normal functioning of the district. Did the events occur, or are they expected to occur? Yet, pretty much yes. The labor expiration will take place within the time period that the financial statements are issued and hasn't yet been resolved. Possible ongoing contract negotiations wouldn't be included because they taking place after the fact. And the government had taken no actions as of the date of the financial statements to actually mitigate these factors. Reminder, you can only consider factors that actually were taken or led to actions that had occurred prior to the date, not actions that were planned for the future. So the government had a resulting potential note disclosure for this. Looks like follows: discloses the bargaining situation, discloses the potential labor disruption, and the potential functioning of the district's operations. So I think this brings us to our last polling question. Basically, how are you feeling today? You learned some new things. Have you got this covered, or are you feeling like you might need some additional assistance, which we'd be more than happy to provide? And after that, I'm going to go over just a 3-slide overview of some upcoming projects, and then we'll close for the day. All right, perfect. Last couple of slides here, thinking about GASB current and upcoming projects. The GASB pretty much separates their project timelines into 4 separate project sections: comprehensive projects, major projects, practice issues, and pre-research agenda. If you were to go out to the GASB website right now, you could look in detail at each step related to all of the listed ongoing projects. In fact, they just issued their technical plan for 2024. So you could view all of that on the GASB's public-facing section of their website. And they would be all of these projects listed here. The GASB work project timeline pretty much looks like things get added to the agenda. There's an initial deliberation. There's always a comment period in each step that lasts for about 120 days, so it often takes longer in redeliberations, preliminary views, and then exposure drafts. We don't usually start talking about them in the financial reporting community until they hit exposure draft, though we might start thinking about them in preliminary views if they're major projects. And we don't really start talking about them in depth until they hit the final pronouncement stage. As of right now, there are probably 2 projects that are either in preliminary views or issues as an exposure draft that really deserve some thought or consideration. The GASB is thinking about a major change to the revenue and expense recognition reporting model and a change to the financial reporting model. Both of those are in preliminary drafts or exposure draft version right now. I've got other presentations and other slides that talk about these in depth, but since we're sort of short on time today, we won't be going into these. Just know that these are probably the 2 that you're going to start hearing me talk about in future presentations as we get closer to having an actual standard issue on either of these topics. Finally, if you learned some interesting things today, this is just the first part in our 5-part webinar series throughout the rest of 2024, talking about topics that are important for local government, not-for-profits, higher education, anyone in the public sector industry. Tomorrow, Paula Bedford, one of our lead partners in the not-for-profit space, will be talking about the not-for-profit GAAP update and giving a deep dive into accounting pronouncements on the NFP side. In May, Corinne Conley, our wonderful HR lead, and Steve Gibson, our fantastic retirement solutions consultant, will be giving a comprehensive guide to driving employee engagement in the public sector, talking about best practices for an engaged workforce and practices for retaining talent. If you stick around long enough, in July, I'll be back here giving a single audit update, talking about preparing for your single audit, changes to the compliance supplement, and the proposed changes that are coming up to CFR 200 and uniform guidance. And finally, in October, Ben Evie and Aaron Trask are going to be talking about maximizing organizational effectiveness through technology. So I hope you've learned some interesting things today, and I hope that you come back and join us for one of these future webinar series sessions. With that, I think I'll turn it back over to our host.
Thanks so much, Dan. This concludes today's program. Thank you all for joining us and for giving us a few extra minutes to cover these important updates. With respect to your time, we'll be reaching out directly to answer all remaining questions submitted. If you would like to learn more, please visit Raymond's website at www.raymond.com. You can also email us at publicsector@raymond.com. Thank you and have a great rest of the day.